We will be moving on to our next speaker now, so fingers crossed technology hasn't let us down, and we have Saul Miller on the line from Johannesburg. Saul, can you hear me loud and clear?
I can. Can you hear me?
Absolutely. Thank you so much for joining us this morning, Saul.
Thanks for having me. All right, can I kick off?
Yeah, for sure. I mean, just as an introduction, we've heard a fair amount from your CIO, Ian Power, on the balanced perspective every month. So we're very looking forward to hearing what you have to say about more fund specifics over the course of the next 15 minutes. Omi did mention a little bit of uncertainty around the inflation number, and your presentation focuses quite a fair amount on inflation. So hopefully we get a bit of clarity there. So thanks, and over to you, Saul.
Great, thanks very much, and thanks everybody for tuning in and listening. Most of the presentation is going to be about inflation and interest rates, but I'm just quickly going to touch on some performance slides and attribution. Just first of all, just a couple of key bullet points about Truffle. We've been around for over a decade now, and we've had a very stable investment team of highly skilled professionals, and we've had a great track record. So all our funds are in the upper decile. Since inception, not just the fund that we're talking about today, and our assets are now at over 32 billion. This is just shows you a histogram of the performance over different time periods. What I really want to focus here is what's happened in the last year, and really what's contributed to the decent performance over the last year. We've broken it up into sectors, and you'll see platinum miners, or the PGM sector, continues to be a great contributor to our returns. We still like the sector. We think there will be sustained deficits in palladium and rhodium due to supply constraints, so we still maintain a reasonable position here. The shares are also very cheap. Diversified miners have really helped us, and we're looking at the likes of a Glencore and African Rainbow Minerals, but we have actually been pulling back our exposure here since we think that profitability levels are particularly stretched here. If you look at the likes of iron ore prices, iron ore miners are now making record profits. So we have been pulling back a bit here. Foreign equity also contributed to returns, despite the rand being very, very strong over the last year. So that's obviously held it back a bit, but that comes from numerous sources. For the interest of time, I won't go into that. And then dual listeds, the likes of Naspers, contributing quite handsomely here. Won't go through all the shares. You can see at the bottom, the ones that have struggled would be the likes of the insurers, the healthcare sector. We think those sectors still look interesting. There's a lot of value over there, so we still maintain our positions there despite them having underperformed, and we've even increased our exposure into some of that underperformance. This just shows you a spread of the different asset classes or investment sectors that we're in the Balanced Fund, and you can see quite a diversified range of sectors. Another interesting point to note here is our net risk exposure, or our exposure to property and equity. That was very high. It was over 75 if we go back to last year. We've pulled that back down quite a bit just because we think valuations in the world have got quite expensive. So it's sitting closer to 64%. We've been particularly worried about the growthy sectors, offshore tech, which have really benefited from very low interest rates, and that really ties into what I'm going to talk about next. But so we've particularly reduced our exposure there. Our exposure is more in the value type sectors, particularly when we talk offshore, and you would include the financials there, sectors that would actually benefit from rising rates, as opposed to tech that would suffer from rising rates. It's also why we've been happy to use derivatives on the S&P, which we think is expensive, and that's actually where we have taken some of our risk exposure off, is via derivatives, S&P and via the all share. We've increased our exposure to domestically exposed companies from about a year ago. We do think the environment in SA is certainly better than it was, both economically and politically. Things seem to be moving. They might be moving slowly, but they are moving in a positive direction. And obviously, SA markets aren't particularly expensive if you compare them to the rest of the world. So that valuation opportunity also allowed us to up our exposure a bit to domestically exposed sectors. And I gave examples of some being healthcare, like a Netcare trading on a sub 10 PE, and there would be numerous other examples. Property, also another area where we think fundamentals are actually going to be quite tough over the next few years, but there are select opportunities. You've got some counters trading on very deep discounts to NAV that do have reasonable prospects going forward. So not every part of the property sector is under massive pressure. If you look at some of the more rural areas, trading has actually been reasonable there. So you should be able to maintain your rentals in some of those retailers in those areas. And obviously some shopping centers are quite iconic. Retailers are going to want to maintain exposure to some of those iconic shopping centers, even if they are cutting down on space overall. So there are select opportunities in that space. I'm going to move on to my topic of interest rates and inflation. We're worried about interest rates and inflation going up and having a negative impact on equity valuations going forward, and we're talking globally here. But I think, first of all, before I go into that, just to mention what are some of the factors that influence equity valuations. And if you look on the right, you've got the equity risk premium. And what that is really the spread that equity holders want to earn over bonds, given the extra risk that you carry when you invest in equities. And if we look at that spread, it's not particularly out of line with history. So we're not particularly concerned with that aspect of equity valuations. If we look at the likes of dividend growth or earnings growth, obviously very important for equity valuations. If we take a long-term view, we would think there could be pressure on earnings and dividends just because of factors like taxation in the US, which are at very low levels and probably need to go up over time, and the fact that labor's share of the economic pie has been particularly low, whereas companies have had a much larger share of that pie. So that might change, and that could put pressure on earnings. But we're talking more of a long-term view. And then finally, what we're talking about today is really the valuation of competing asset classes with equity, and in particular bonds. So when bonds get expensive, obviously people will find other assets to buy, and equity would be one of those assets that they would go into. So low bond yields have essentially pushed up not just bond valuations, but also equity valuations. So why are we worried about bond yields going up? Well, we've had quite a lot of stimulus, as everyone's aware of. And what's nice is just to look at these charts that put that stimulus into a bit of context. If you look at the chart on the left, what we actually look at is the economic destruction that was experienced during the great financial crisis of about 10 years ago versus COVID. And you've got the GFC in dark green and COVID in light green. Whether you look at the US or the Euro area, you can see that the losses suffered during COVID were a fraction of what they were of the financial crisis of 10 years ago. Yet, if you look at the charts on the right, if you look at the size of the stimulus, it's almost 4 times higher. So we've seen the exact reverse in terms of the stimulus. The government really wanted to be very, very proactive, and they stimulated very aggressively, both in the US and the Euro area. Another chart that kind of puts the size of the stimulus into context is by looking at the US debt to GDP, because that stimulus goes into debt. The purpose of this chart isn't to sort of highlight or bring about a discussion on the merits and demerits of having high levels of debt. It's more really just to show you how much it increased by and how much it's going to increase by in such a short period of time. So what does all this stimulus mean, and why is it an issue for inflation and interest rates? Well, economists often like to talk about where GDP is or where it's going to versus where potential GDP is. If the demand in an economy is going to be higher than what the capacity or the potential capacity of an economy is, that can often lead to inflation, just like it's what you would expect similarly for a company. If you're operating at full capacity, companies can generally charge more. When an economy overheats and it is operating at above its capacity, you can have inflation. And if you look at the last sort of 15 years, most of the time the US economy has actually been below potential GDP, which is generally quite disinflationary or even deflationary, whereas now we are expected to go above what the potential productive capacity of the economy is. In fact, forecasts for the US economy are actually higher now than what they would have been pre-pandemic as a result of all this stimulus. So certainly a worry for inflation going forward. What's interesting is to look at the subcomponents of the inflation basket, the US inflation basket. And if you look at 2 components here, the one is in light green is the goods that have been demanded over COVID. In other words, goods that wouldn't have been under pressure as a result of lockdowns, whether it's food or IT equipment and so on. And you can see that's actually gone up a little bit. But what's more interesting is to look at the goods that are sort of mobility related, goods and services that have actually suffered during the pandemic. So the likes of airline tickets, for instance, and you can see that has actually been very negative, so very deflationary, sitting at sort of a -6 to -5% level. As the economy, as people get vaccinated, there will clearly be a return and a demand for those services, and you would expect that deflation to go back to inflation, which will certainly put pressure on inflation going forward. Unemployment, also obviously a very important factor in terms of inflation. As economy goes back to full capacity, you would expect unemployment to fall, and that clearly puts pressure on wages and wage inflation, which drives inflation. But also, very interestingly, is to look at the relationship between unemployment and the rental component of CPI. And there's a very strong correlation, as you can see here. The reason why that's important is because the rental or the occupancy component of CPI is the highest. It's the highest portion of the CPI basket. It's over a third of that basket. And as we see unemployment fall, you can expect rentals to rise up, which is not unsurprising. As more people get employed, there's more of a demand for housing. Definitely a tailwind for inflation, or at least a factor driving inflation higher. We've also had a lot of regulation preventing rental increases. So we've had caps. Those will fall away as COVID goes away, also putting further pressure on rental increases, which put pressure on inflation. What's interesting to look at is inflation expectations implied in the bond market. Now, we know that over the short term, the bond market is expecting inflation to rise above the Fed target of 2%. But what I'm doing here, or what I'm showing in this chart here, are more medium-term expectations. So inflation expectations looking at sort of 5 to 10 years out. And what you'll see here is that they're very much in line with where they've been over the last 5 years, and very much close to where the Fed target rate is. So despite all the stimulus, despite the economy probably going to above its capacity, the bond market is not expecting any overshoot in long-term inflation. So certainly there's a source of risk here if inflation lands up being more permanent and we have some second and third round effects of inflation that they can't get rid of. Another very interesting chart is to break up bond yields into two components. And you can break up bond yields into inflation expectations and the real yield component of a bond. The real yield is really the yield that you get on inflation-linked bonds, which are traded bonds. You get those in South Africa as well, and in many countries. And what you can see here is what's really driven bond rates down hasn't been so much inflation expectations, which is what you see in dark green. That's been stable-ish. What's really driven bond yields down over 20 odd years has been real yields falling, and real yields are now negative. So the worry here is even if inflation does come under control and we get this economic growth without an inflation spike, the question is, why would bondholders be happy to receive a negative return relative to inflation? I would think that would be unlikely, and that real yield would actually have to go positive, if not even higher, to 1% or so. And that would obviously be very negative for bond yield. So you're not solely reliant on inflation going up here. The real yield can also drive up bond yields, and that would obviously have a negative impact on equity valuations, we would think. So there's really a multitude of factors other than inflation that make us worry about yields going up and hitting equity markets. If you look here at this slide, what we're showing is valuations of different equity markets and different sectors of the equity market versus their valuations over the last 10 years. And you'll see pretty much all sectors and regions are expensive. In particular, the growth areas of the economy, which we're talking about tech type shares, are particularly expensive. You can see the world MSCI growth index is 66% above where it was. But even the value index is a bit above, and countries that are very over indexed to growth type sectors like the US looking quite expensive. However, there are certainly sectors and shares that are still offering reasonable value. And you can see we've put in two shares there, Heidelberg, Lloyd's, two shares that we own that are trading below their long run averages. Financials in general are not particularly expensive globally, and they will actually benefit from rising interest rates. And then SA, you can see also not looking particularly expensive, and hence why we have actually upped our SA exposure from where it was a year ago. So there are opportunities, which is always important to remember. We're not just completely victim to these very low interest rates and valuations in equity that are expensive in aggregate. So this is just the final slide on our positioning of the fund. I think I've covered most of these points. As I said, we still overweight PGMs. We like the supply and supply-demand dynamics. We think there'll be deficits. We still think there's some value, some of the Rand hedge shares on the JSE. We think there are opportunities in SA shares. Obviously, that does depend on government continuing with what they've been doing in terms of improvements politically and economically. Property, there are select opportunities, despite the sector on average probably being under a bit of pressure. And globally, we're far more focused on the value type sectors rather than the more expensive tech sectors. Thanks very much.
Brilliant. Thank you so much, Saul. If we were to compare the portfolio today versus maybe the end of last quarter, there have been some interesting additions to the fund. So off the top of my head, you've added some US banks, I think the likes of Citibank and Wells Fargo. Similarly, in the UK, you've added NatWest and Lloyds as well. And I know you are an insurance analyst, and Ping An Insurance has been a decent holding in the fund for some time. Have these holdings and additions largely been informed by what we're seeing in terms of the rate cycle?
So they've been offering reasonable value for quite some time, but in order for them to generate decent earnings, that is going to require the rate cycle turning. Obviously, very depressed interest rates are not good for banks in terms of their net interest margins, since you can't really charge depositors too much money. You know, it's generally you shouldn't be able to charge them anything. So you want rates to go up so that you can start that you don't take any pressure on that front. So we think the rate cycle is definitely an important factor in terms of being a catalyst for banks to do well going forward. And that is why we've finally upped our exposure. So you've had value on your side for quite some time. Now, at least there should hopefully be a bit of a tailwind to earnings. They'll also obviously get a tailwind from COVID receding. As economies open up, you're not going to have the provisions that you've seen. In actual fact, some of the provisions might have been overly large. So we'll see some of those scaled back, which should also be positive. And you should see dividends coming through as well. So there's probably a multitude of factors that sort of informs our decision to up our exposure to financials. And they're one of the few areas that are cheap in this world where most things are expensive.
There are a couple of more glaring things as well in terms of the fund. So you've sold down in fact, the entirety of your offshore fixed income component. I mean, I think if we rewind a year ago, there was a first rand dollar bond, which was the single biggest
Correct.
position in the fund. You sold that down to essentially zero, but your US dollar cash position is, I think, around 7% of the fund at the moment. So the question is twofold. Is it moving out of the offshore fixed income because yields are relatively low? And then the dollar cash position, is that a prudent effort, or is it more the fact to have some dry powder to deploy when opportunities present themselves?
So our offshore dollar bonds that we had, and you're right, they were mostly first rand bonds. That was really a factor of yield compression, so that we just felt there was less value in them. They had done particularly well in terms of those yields being squeezed and getting a bit of a capital gain. So that is why we sold out of those. We actually moved some of those at the time that we did it into more equity. Subsequently to that, as valuations have gotten expensive, we've obviously hedged a bit more and sold down a bit, and that's why you see the higher cash component. So we are hoping, as opportunities present themselves, to reinvest some of that cash going forward.
Fantastic, Saul. That's 20 minutes on the button, so really appreciate your time this morning. And I think I failed to mention at the beginning of the call that Saul is a portfolio manager at Truffle Asset Management, and they obviously manage our Nedgroup Investments Balanced Fund. So, Saul, thanks again, and take care and enjoy the rest of your day.
Thanks very much, David. Have a great day.